Wealth Mentor. Welcome to RichTrybe. Look, most people out there think that finally saving up $1 million is the finish line. I'm telling you right now, it's not. The real game? The real game is making sure that million doesn't vanish before you do.
Wait a second. So are you saying everything we've been taught about retiring rich is just wrong? I mean, build a solid nest egg, withdraw a safe little percentage every year, and go live on a beach. That's the standard math, right?
Honestly, that oversimplified advice is a perfect blueprint for running completely out of money by the time you hit your 70s. I've spent years studying how the ultra-rich actually handle decumulation, which is just a fancy word for spending down your wealth. Today, we're cutting through the noise. We're looking at hard, undeniable data from Vanguard, Stanford University, and elite wealth managers. We're going way beyond the basics so you can actually keep what you build.
Section 1. The Compounding Wealth Blueprint.
Okay, before we even talk about pulling money out, how do we actually build that elite level of wealth? Is there a real-world roadmap for getting that kind of explosive growth?
Absolutely. The most powerful framework I've ever seen is the 8-4-3 compounding rule from Fiducian's advisors. When you actually understand this, it completely shifts how you view patience and keeping your money in the market.
So, here is exactly where the average retail investor fails. They get bored. During the first 8 years, the foundation phase, progress feels agonizingly slow while your little snowball is just starting to form. Then, in years 9 through 12, you hit the pace phase. The snowball effect really accelerates because your earlier gains are now generating their own returns. But the wealthy, we know the absolute magic happens in the final 3 years, the expansion phase. The growth here is literally explosive. It often exceeds the total returns of all those earlier years combined. That tight 3-year window is where true generational wealth is actually forged.
But what if I'm just a really good active trader? Couldn't I just time the market jumps to speed the whole thing up?
You will lose. And the data from the Bank of Singapore proves it. Imagine a hypothetical $100 investment earning a consistent 8% over 20 years. If you pull your returns out to spend, it just grows linearly, a flat $8 a year. But with compounding, where you leave those returns alone to reinvest, the gap becomes absolutely massive. By year 20, the compounding portfolio has 80% more value. Time in the market will always beat trying to time the market. Period.
Moving on to Section 2, Why the 4% Rule Fails.
Okay, so now that the wealth machine is built, isn't taking the money out pretty straightforward? You just withdraw your 4%, adjust it for inflation every year, and you're golden.
That right there is a massive, devastating myth. That whole 4% rule comes from the 1994 Trinity study. But here's the catch. It assumed a traditional 30-year retirement horizon. If you're a high achiever aiming for true financial independence and retiring early, you aren't looking at 30 years. You are looking at a 50-year timeline. And for a half-century horizon, 4% is not just inadequate, it is incredibly dangerous.
Look at Vanguard's data. It shows that if you apply that exact same 4% rule to a 50-year horizon, your probability of success absolutely plummets. It drops from a decent 82% all the way down to 36%. Wait, seriously? So if I retire early relying on the standard 4% rule, I essentially have a 64% chance of going totally broke? Exactly. You are basically flipping a loaded coin with your entire life savings. So what is the actual mathematical solution to odds that terrifying? Economist Karsten Jeske hits the nail on the head here. He argues that early retirees need a much more conservative baseline, roughly 3.25% to 3.5%. This isn't just about spending less. It's specifically designed to protect against sequence of returns risk. That's the absolute nightmare scenario where a major market crash happens right at the beginning of your 50-year retirement. You need a buffer.
Section 3. The Hidden Inflation Paradox. Now, the ultra-wealthy view inflation completely differently than the middle class does. A brilliant Stanford University study breaks this down. During high inflation, if you hold fixed claims, like bonds or cash sitting in a safe, you are the loser. Your purchasing power is quietly being destroyed. But if you hold fixed debts, like a massive 30-year mortgage on a prime property, you are a massive winner. You are paying back the bank with cheaper, inflated dollars over time. The millionaire's perspective is simple. You weaponize bank debt against inflation. The borrower gains and the lender loses.
So how do the wealthy actually execute this in their daily portfolios? Well, I can tell you they don't cower in cash. According to the Center for Retirement Research, high net worth households use highly strategic preservation tactics. They leverage real estate for steady appreciating cash flow. They utilize Treasury inflation-protected securities, or TIPS.
They maintain surprisingly high equity allocations, and they acquire business assets that naturally scale their prices upward as inflation rises. Simply put, they buy the exact assets that outpace the invisible wealth killer.
All right, Section 4, Advanced Decumulation Science. I definitely get the asset side of things now, but going back to withdrawals, what exactly is the traditional model people are using that's causing them to fail so badly?
It's a rigid concept called dollar plus inflation. Basically, you take a fixed dollar amount and blindly adjust it upward for inflation every single year, even if the stock market happens to be crashing. I'm telling you, doing that is financial suicide. The elite alternative, the one proposed by Vanguard, is dynamic spending. It's flexible. You strategically cut back your spending just a little bit during market dips to save the portfolio from draining too fast, and then you reward yourself with higher withdrawals when the market inevitably rebounds.
Remember that dismal 36% success rate we talked about for a 50-year retirement? By simply shifting away from rigid withdrawals and adopting Vanguard's dynamic spending rule, you push the probability of that exact same portfolio succeeding all the way up to 90.3%.
No way! That's incredible. So you didn't even have to save an extra dime. You literally just used better math to manage the withdrawals.
But wait, doesn't standard financial advice say you should get way more conservative as you age? Buy more bonds, take far less risk?
Yes, and that average advice leads to average, or in this case, ruinous results. Cutting-edge research from NetSpar introduces a highly counterintuitive strategy called the reverse glide path. Their data actually shows that gradually increasing your risky equity assets during your retirement drastically improves your terminal wealth. If you just hold overly conservative assets that don't grow, that is exactly how you run out of money. You don't just have to beat inflation, you have to outrun longevity risk.
Listen, simply living off depleting assets creates a sheer poverty mentality. If you do that, you'll spend your later years constantly watching the meter tick down, terrified of every single market correction. You cannot just coast on an oversimplified rule of thumb. True wealth preservation, it requires ongoing mastery of leverage, continuous learning, and robust investing skills throughout your entire life. You built the machine, now you have to actively manage it. And speaking of continuous learning, before we get to the final, absolutely most crucial piece of this puzzle, make sure to subscribe to RichTrybe channel, like, comment, and share. Join our community of ambitious earners so you can master elite financial science and stay way ahead of the curve. Finally, Section 5, True Financial Independence. So, stepping back for a second, what is all this complex math actually for? What really happens after you build the perfect portfolio, beat inflation, and secure that dynamic withdrawal rate? At the end of the day, money is simply a tool. Its only real purpose is to buy back your time. Unlocking true work-optional status grants you the 5 freedoms: absolute peace of mind from bills, total control of your daily schedule, the freedom to roam and live anywhere on the globe, the ability to pursue purpose-driven work rather than just clocking in for a paycheck, and true, unshakable independence. That's the real prize. I guess my biggest fear is sacrificing too much of my actual life, missing out on things now just to build that perfect money machine for later.
And that is an incredibly valid fear. Financial expert Mel Abraham points out the ultimate failure in all of this, the complete emptiness of wealth without relationships or experiences to share it with. Just look at history. So many Victorian self-made millionaires died incredibly wealthy but utterly miserable. They built the money machine flawlessly, but they completely forgot to build a life.
Which leaves us right here. You now possess the advanced science to build and protect true wealth. You understand compounding blueprints, dynamic spending, and exactly how to weaponize debt against inflation. You know how to build the money machine. But the ultimate challenge I leave you with today is this. Are you actively prioritizing your health, your family, and your relationships to ensure you are actually building a life worth living? Think about it. See you next time.